Hello and welcome. Coming up in this week's stock analysis video, we are going to look at E.L.F. Beauty. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. And for EPS, this is an amazing 105% increase. Now let's look at the free cash flow, which is the money a business can generate from its operations. However, their free cash flows dropped by 43% last year. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Although revenue has increased by 46%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. Book value is 40% up. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. And return on invested capital and return on equity are very healthy at 14% and 21%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. And the debt is a little bit higher than we'd like, as it's nearer to 5 years at 4.83. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. At 71%, this is looking very healthy. Next we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Apple's operating profit margin is 17%. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability than traditional earnings or dividend yields. He typically looks for a company that has a free cash flow yield of 5% or higher. And this is a little weaker than we would like, as it's 0.66%. After that, we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. The PE ratio and the enterprise value to EBIT look a little high at 70 and 67. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. Having looked at the key pillars, let's give E.L.F. Beauty an overall score. I've given debt, free cash flow, PE and enterprise value to EBIT, free cash flow yield, no marks, but everything else a point each. So the key pillars for E.L.F. is 7 out of 12. If you're interested in reading the annual report, I've included a link in the description below. E.L.F. is a mid-cap company and Morningstar believe they have a narrow moat. Now let's look at the ownership. There are currently 2 super investors who have bought this company. If we look back at Ken Griffin's previous sales and purchases, we can see he has both bought and sold shares in E.L.F, but in the last quarter he has bought 3,000 shares. However, 4 other super investors have sold shares in E.L.F. Joel Greenblatt has consistently bought and sold E.L.F over the last few years. In the last 3 quarters he has been selling. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. As we can see, the average share price since 2018 has been increasing, and over the last 2 years E.L.F. Beauty has seen their share price increase sharply. So let's see what the analysts think. On average, the analysts believe that the price target should be about $184, but some believe it can go as high as $230. Contrasting analyst reports suggest that E.L.F is overpriced, whilst others believe that they are currently at fair value. The overall consensus is that E.L.F is a strong buy, and collectively the analysts believe the company will continue to grow at about 20% over the next 5 years. Now we've looked into the past, let's project into the future. So we'll use a current EPS of 2.24 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate the EPS will be about 20%. And I'm going to give E.L.F a PE of 40. After that, I'm going to project these numbers forward by 10 years. This then gives me an estimated future stock price of $555 per share for its future value. We then need to include a 15% return, and then we work out the current value that Phil Town calls a sticker price, which is $137. And then if we apply a 50% margin of safety, it gives us $69. Or if we apply a 20% margin of safety, it gives us a target price of $110. In this next section, we're going to split the chart into different zones. Our first zone is the market bottom for E.L.F, which I think is about $21. Then we come to zone 2, which is between $94 and $146. And we're currently in zone 3, which is between $146 and $209. And finally, zone 4 is what we identify as our exit strategy, or at least the point we want to take some profits off the table, which is over $209. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. So using the model, it suggests that E.L.F is currently undervalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. So at 1%, this suggests it's overpriced. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. So at 66, this also suggests the company is overvalued as well. Finally, I've also included Phil Town's earnings per share growth model that I used earlier. This suggests that based on the growth valuation, it's overvalued and above my sticker price. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. The return we receive if we bought at $157 and sold at $222 would be 41%. We would see a return of $167 if we bought at the 52-week low of $83 and sold at $222. Finally, let's summarise what we found out about the company. When reviewing the key pillars, E.L.F scored a better than average score of 7 out of 12. Under ownership, 2 super investors have bought in the last few quarters and 4 have sold some shares. In the past 5 years, we can see the average share price has trended up. Analysts are indicating E.L.F is a strong buy and they are predicting that they will grow 20% over the next 5 years. Using different valuation models, my personal buy price would be at present $110 with a 20% margin of safety. My final overall rating is 2 stars out of 5 and I've given this a category B rating within my own stock watch list. This is simply because at present the stock seems a little overvalued. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.